In this month's report, what we've done is we've kind of emphasized kind of more of the sectors at play. We wanted to put a little bit more emphasis there.
Okay, so I mean, we've been discussing actually the sort of the big theme that, you know, this is a liquidity fueled bull market, liquidity dominated. And I think this chart that we had in PSL this month really does a great job of illustrating basically in rough form, every single decline and every single rally came on some sort of policy shift during the entire 2009 to 2020 bull market. At first with QE1, QE2, Operation Twist and QE3, and then with the foreign versions of that, with policy tightening in China, combining with a flattening of our own QT to produce 2015, 2016 decline, and then we got sort of coordinated policy stimulus from the other major central banks of the world, led to the big rally, and then the Trump tax cuts that helped fuel further. We had tariff problems, we had policy tightening, etc. Pretty much everything we've had has been very closely correlated with policy shifts. Some economists have done some basically some statistical testing. It basically shows 93% correlation with policy shifts and market action. So, and that's probably the most extreme example. Another extreme example where policy really dominated market action was in the 1932 to 1941 market, and that was more combination of monetary and fiscal stimulus. And there, economists generally have something around a 70% correlation. So the point that I want people to get, we've been talking about how all this policy stimulus is pushing these markets higher. So that some of the things that are really common between those two markets are, one, that they are the most extreme in terms of the market going far further than GDP growth. If you do a long-term chart of GDP growth in the S&P, what you'll find is the S&P kind of is like an oscillator. It goes to, you know, far above growth in bull markets, and then in bear markets it goes below, and GDP growth kind of goes in the middle. But these two markets stand out, these policy dominant markets stand out, where we had a 50% GDP growth from 2009 to 2020, and we had 500% increase in the market. And same thing during the Great Depression. So policy dominated markets tend to be very highly correlated with policy developments. So you really want to keep your eye on them. And they tend to be the markets where valuations and everything else can get way out of whack with the underlying fundamentals. Okay, so what I would say is we are starting a recovery. We've talked about in past reports, you know, the cyclical situation. We're in early recovery, and those early recovery themes really kicked butt over the last month. One of the reasons that we had such a good month is because we're able to shift into those. And those are even dominating the relative strength tables now. So it's been a big shift. And that continues those early recovery themes like industrials, materials, energies, financials, housing. Those all tend to be what are showing strong relative strength now. Those are early recovery themes, and we think those are still the better plays, but you're likely to get some short-term volatility in here. As we've seen, we continue to be a recovery theme, but maybe toward the end of the summer, toward the fall, we'll start getting actual talk about tapering, and that's where you have the risk of a bigger, more intermediate term correction. All right, let's talk about bonds. Last month, we talked about how we have this target here in this 1.7% to 2% sort of zone, and that at that time bonds were interest rates were really rising sharply, and we said they're likely to pause. This is significant resistance, and it's likely to lead to a multi-week to multi-month pause. We got that pause off the 1.765% TNX level, and we've sort of consolidated. You can see the bounce in bonds from that consolidation. That bounce is really so far contained into sort of the HVN here, and so it's quite possible that we're going to get a volatile range here in interest rates for a while. We may not have the impetus to push rates higher. It doesn't look like just inflation rising on a temporary basis is going to be enough to push 10-year rates through this key sort of 2.16% level. We get through that, we're really off to the races again. But until then, we're likely to be very volatile here in this range. So you kind of have an upward bias intermediate term, and maybe still a little bit of a correction or a consolidation on a short-term basis. So our themes are similar to what they were. They're short bonds. We would go with TBF, which is sort of not fully leveraged, not full duration right now for an intermediate term outlook. And then once that 2.16% gives way, we would switch back to higher duration and more leveraged short bond things. And then a lot of the high yield. So high yield closed-end funds and high yield closed-end funds trading at a discount are two of our top themes, and then short-term tips. So you've got, and then convertible bonds. So really a lot of the plays are equity-like plays, high yield bonds, convertibles. They're not, we're negative on the bond outlook, and you want to be shifting into areas that are not going to be hurt by a sort of a continued rising rate period that seems likely ahead. Okay, in terms of currencies, last month we were here and we were talking about this 93 to 95 high volume node resistance level was likely to stop the dollar bear rally and turn it lower. That's pretty much what we've got. We barely got into it. It sort of hit this uptrend channel, hit the resistance, went above Bollinger Band, had a lot of things going for it on a short-term basis for shorting, and now the dollar's turned down, and it's turned down actually probably a little more sharply than I would have thought. And that's helped gold bottom, and it's helped commodities do well, and it's helped materials and a lot of those cyclicals trade. And this is really, I think you want to also understand, this is what policymakers want. They want a lower dollar, regardless of what they're saying. That's really, this is more like a 2002 recovery where the weakness of the dollar is a big part of the recovery. The recovery abroad is still much weaker than the US, and so they want a weaker dollar. They really want to fight a stronger dollar. And then just remember, there's this 6-year cycle, 6 to 9 year cycle in the dollar that's been very good to us over long term, and that to us makes us have a bias that we're actually in the trading range here. We're going to break down ultimately below 88 and go test these low 70s levels. Ultimately, that is our sort of hypothesis of where we are, but we're coming up to a really big test, this 88 to 89 level. You can see we talked about this level when we were declining into it, and you can see what a substantial bounce we got off of it. It's pretty strong support. Whether it really breaks this level or not, there's going to be a tug of war. So you're probably looking at weeks to months of fighting here off this 88, 89 support, and maybe a trading range between 92 or thereabouts for a while before we get maybe something like a policy capitulation toward yield curve control or something like that, maybe something abroad that is much more stimulus that would lead to a sort of a breakdown, further leg down in the dollar. So that's a kind of a hypothesis. And so we like, our favorite play is still the Aussie dollar. We like the Aussie stocks, and the Aussie dollar really didn't get very much of a correction while the dollar bear market corrected. And now we've had sort of a head and shoulder bottom, sort of base off that's been broken out of. And then just realize there's potentially skewed upside potential if we do get that breakdown below 88 in the dollar and below this 81.50 level in the Australian dollar. That sets up a major multi-year head and shoulder bottom with targets in this 105 type area. So that's going to have a lot of huge potential upside. If we can break through, we're likely to get a real tug of war in here as we get up to those levels until that breakout though. So that remains our top currency theme, long the Australian dollar against the US dollar. And we may have trouble here. You may want to take partial profits, above 80, 81 area, and then maybe try and buy it back on some kind of correction or consolidation. And if it breaks through, add to the position. Okay, and so the weak dollar, of course, has been very, very good for commodities. Last month, we were talking about copper coming down against this trend channel and moving average support, and we suggested you could get a run to test prior highs. We not only rallied off that, but we have broken through prior highs. And when you look at a monthly chart, you really didn't get very much of a correction at all. This copper is trying to break through this like a hot knife through butter. It makes it more difficult to get in if you're not already in, because there's not good places to put protective stops. But I think it also gives you an indication of the potential upside. Just, to give you some flavor on this, a number of European investment banks and Goldman Sachs have issued reports where they suggest copper prices could triple from here during the course of this entire recovery because of the emphasis by so many countries on infrastructure and clean energy, both of which really, really depend on copper. If you're a small trader, this is a time to buy, hundreds of dollars worth of pennies, put them away, because it's kind of like in the late 70s where you could buy those 40% silver $0.50 at face value, and really the metal was worth more than the coins. There's no risk to the trade because you're always going to get your cent for it, except at least in nominal terms. And sometimes you can sell those bags many, many times what you paid for them long term. It's not something you can do with big capital, but it reminds me of that. We're at a situation where the copper now is above the price of the penny, so you're actually being able to buy value by buying a penny. So copper remains one of our top themes. It's going to be volatile. It's probably going to be watching this trend channel closely. So when we get up, towards trend channel resistance, you're going to get maybe another opportunity for at least a slowdown or another correction. And it's going to be a volatile play, but I think that over the long run, it's going to be very good. We really like the copper miners and really like copper on an intermediate term. And it's one of our favorite commodity plays. Another one of our favorite commodity plays is just the commodity indexes themselves. So while we've had copper on this run that didn't really even get this setback, commodity indexes have also had an incredible run. Remember, way back here, we were talking about how we were likely to get this super cycle in commodities during the next recovery. And so far, it looks like that super cycle is indeed developing. The amount of momentum that we're getting in this move up in commodities has been unseen since the 70s. Usually a high level of momentum in a first leg up is an indication of the potential. And if you look at this on a long-term basis, this is a CRB, you're looking in this monthly chart, you're looking at, just like we have in copper, just like we have in the Australian dollar, this huge potential head and shoulder pattern that projects up to around 300 minimum in the CRB. And so we could be looking at, it may, of course, we've got some, we got some resistance to break through still at 207. Really want to break through it solidly. Haven't really done that yet. But once we do that, there's really a lot more upside. And I think that just owning commodity funds, things like that are in our ETF list, it's going to be very good for your portfolio and going to be a key major theme to look at when we get through resistance. Now, we were talking about last month Here we were in this double bottom off our major support level, this 157 to 158 level that we said if gold went down below, that would change our outlook. We did not go down below that level. We got the double bottom off it, and shortly after our talk, we broke out of that double bottom, and we've seen a nice start up in gold. We suspect that's a beginning of the bottom of the 13.5 month cycle higher. We've broken through downtrend channel resistance. We like gold, and we like some of the like RGLD that's just broken out of a Head and Shoulders. And if we can continue to break through some of these other resistance levels and continue to look good internally, we'll begin adding more. What we really want to see is better relative strength. We have broken out of a double bottom in gold in relative strength terms in the S&P, which is good, and we have broken some of the downtrend line resistance, which is also positive. So I think you can begin adding exposure a little bit. I would like to see it get above the 200-day EMA and break through some of these other resistance levels and look good in here in doing so to really get more excited about it and expect really more consistent relative strength highs.